Hello, everyone. Listen, thank you so much for tuning in. Today, I wanted to address a question that someone had, and I think it's a very valid question. They're saying, I know that this is just a scenario, but if your income is $2,000 and expenses before your savings is $2,300, how can you save $1,000 a month? How can you save $1,000 a month when you're bleeding cash $300,000 each month? I mean, it's a negative cash flow each month. It's 2,000 minus 2,300. And so that's a very good question. Right? That's a very good question. But I want to kind of put the answer in a frame where you will be released from the matrix that you've been taught you have to stay in. All right? Are you ready? Here we go. Remember that there are 4 types of expenses the whole time you're here on earth. 4 types of expenses. All right? Here we go. It's going to be, one of them are going to be productive expenses. All right, productive. The second one is going to be protective expenses. All right. Number 3, it's going to be lifestyle expenses. And number 4, who can say number 4? Do you remember what number 4 is? For those of you that are evangelists, specialists. What's going on, Samuel? Thank you so much. I'll give you a little shout out there. You're going to be in for a treat. We have a special video for you coming up. All right. What? Destructive expenses. Destructive expenses. So remember that when you are a business owner, and you are endeavoring to create a legacy for your family, you need to keep in mind that the productive expenses, it's okay to go in debt on. Because you're working, you're striving, you are thriving in order to leave a lot behind for your community, for those you love, those you care for. All right? Productive expenses are going to be those expenses that are going to assist you and others in gaining more value while you're here on earth. Okay, so it's going to be for your business. This could be investments that you have, productive expenses. These are going to be for your real estate that you have. Perhaps there are assets, paper assets, or real estate as an asset. Those are going to be the assets, maybe even crypto. Okay, productive expenses. Protective expenses, that's going to be insurance. Okay, insurances that you get for maybe your automobile, for your home, for your life, for your health. Those are protective expenses, and they actually protect your wealth. Okay, so the productive expenses, they produce wealth. Okay, the protective expenses, they protect wealth. You need both. You need both, absolutely. Lifestyle expenses, that's going to be the groceries. Okay, that's going to be, you want to go out to vacation somewhere, and those are the lifestyle expenses. Destructive expenses, well, those are expenses that don't get used. All right, thank you so much, Garrett Gunderson. All right, they don't get used, meaning maybe your membership somewhere, that you're not using. Perhaps it's a subscription, right, that you're not utilizing, right, to the fullest. You're paying hundreds, thousands of dollars each month, and you're not using it. Or maybe you're getting the magazine and you're just reading one page of it, of a 55-page magazine, right? Listen, you don't have enough time for it. Well, you go ahead and you cut back on those destructive expenses. Let's go ahead and cut back on those destructive expenses. Can we? So the person who has that scenario, and I know it's just a scenario, but if this is you and you're bleeding cash flow, info@velocityseed.com, we want to look in there right? We want to look in there and we want to see inside of the of your matrix, inside of what you're able to give to us, and we want to see what destructive expenses that you can kind of cut off in order for you to be better. Less is better. Let's work on being an essentialist. Absolutely, because less is so much better. So if you're looking at these and you still, so you cut out the destructive expenses and you still, right, you still have bleeding cash flow, then let's go ahead and see what we can do to start producing you the wealth that you need. Okay? Absolutely. Because we don't want to change your lifestyle too much because we understand your human value. All right? We want to make sure also, okay, and did you guys get this down? Let's go ahead and get this down. Productive, protective, lifestyle, and destructive. All right? Because we want to show you one more thing. And we want to get it. We want to bring you to the point where you understand this thoroughly, that credit cards are not bills. We've been taught they were bills incorrectly. They are not bills, okay? Let's say you owed $12,000, okay, balance, and $500 a month was the minimum monthly payment, okay? And let's say that's at 21%. And you only made $2,000 each month. So the income coming in is $2,000 each month. Okay? Now what you were used to doing was you were used to putting that paycheck inside of your checking account. This is a bank, y'all, right here. 2K. So now the 2K houses in your checking account. And then from there, you were used to paying the $500, right? So that you're now left with, right, $1,500 stuck at the bank, making the bank money. Instead of doing that trash, all right, place this $2,000 in here. Yeah, place the $2,000 inside of your line of credit. Guess what? This balance of $12,000 now goes to $10,000. And how much of the money can you use? 100% of it. All right. If you pay it before the 30-day due date, check those terms and conditions. The large print giveth, the small print taketh away. All right. And you no longer have a minimum monthly payment of $500. And plus you still got the $2,000 you can use. So $2,000, always remember this, $2,000 is greater than $1,500, which is what you would get in the bank, right? That is velocity banking in a nutshell. And that's why your credit line, your credit cards are not bills. What bill do you know of that you can borrow from the electric company, the money you gave to them, and then pay them again, and then borrow from, and then pay them again, and then borrow from? All right? You say, well, CJ, the 21% though, I mean, I'm going to have that balance of $2,000 for at least 3 months. And that's going to rack up, man, right? Not necessarily. Not necessarily. Why? Well, let me erase this. And I want to show you, okay? I want to show you. $2,000, right? Multiplied by 21%. You say you got a balance of $2,000. Multiply that by 21%. Now, this could be any amount, all right? 12,000, 15,000. This is just for easy math, okay? $2,000 is your balance. And you said you're going to have it for, what, 3 months? All right, 3 months. At 20, let's just say 20%. Okay, let's make it real easy. 20%. Now, this money, this number right here, it doesn't mean anything. This could be 30%, this could be 40%. Remember, this is simple interest, folks. All right? This is simple interest. So it's going to be way different than amortized interest. It's going to eat your pockets up, okay? You're on a schedule and all that. With simple interest, I want to show you how simple interest is much better and why we utilize simple interest to pay off those massive student loans, amortized debts, mortgages, whatever, debt pledges. Did you know mortgage means debt pledge? Gross. Now, $2,000 at 20%, you said you're going to leave it there for 3 months. Now, mind you, this $2,000, if it's an unsecured line of credit, if it's an unsecured credit card, it's not your $2,000. Let me say that again. If it's unsecured line of credit, or if it's an unsecured credit card, it is not your $2,000. Ain't that beautiful? So, with someone else's $2,000 at 20%, I know you felt lighter right now. $2,000 at 20%. Let's go ahead and multiply that, shall we? 2,000 at 20%, which is 0.2. We're just going to go ahead and get all those zeros out the way. 1, 2, 3, 4, right? And then we're going to multiply 2 multiplied by 2 is 4. And then, since we have a decimal here, 1, 2, we're just going to bring it here. 1, 2. It's going to be $400. CJ, $400? Yeah. So, if you were to keep this amount the whole year, it'd be $400 in interest. But you're not going to keep it for the whole year, are you? No. You're going to keep it for what, 3 months, you said? All right. So, what we do is we go ahead and divide this by, that's right, 12. We're going to go ahead and divide it by 12. We're going to put the 3 right here. 36, 40. All right. There's 3 again. And 36 again. 4. And it's going to be, something tells me that's going to be 3 repeats. So 33.33 cents each month. Now, you said you were going to have 3 months, right? Okay. So 3 months is going to be what? About $99. So the cost of you borrowing that $2,000 is going to cost you about $99. Again, check with the terms and conditions. The large print giveth and the small print taketh away. Those terms and conditions, man. The $99 is how much will be paid out to the credit card company, the credit line, for that interest. Because that's $99 of interest, because you kept that balance of $2,000 for the 3 months. And I don't know about you, but paying $99 to borrow $2,000, that's what I call leverage. God bless you. You take care and have a great night. If you have any questions, don't hesitate. info@velocityc.com. We got a calculator coming out, y'all. It is in the works as we speak. I'm talking to my producer. I'm loving what I'm hearing, but I got to go through the alpha testing. I got to go through the beta testing. We do lambda testing, theta testing. We're going to go omega testing because we got to have this work. Take care, y'all. God bless. Have a great night.